Hello, my name is Gosselin from Australian Fund Monitors. We monitor and research over 400 managed funds available in Australia. Managed fund research is a really complex area. The bottom line, the most important part of any research article is the performance and the risk criteria. And the performance and risk can often be measured, so it's quantitative. What's the performance been over a certain period of time, and how much risk has the investor or the manager taken in that fund? But there's a lot more to it than that. And the research into the manager and the processes and procedures is quite complex. And it can't be done without considerable experience. There are a range of research providers in the Australian market. One of the question marks that comes up the whole time is the research is paid for by the managed fund itself. So you've got the product issuer paying for research. And that immediately brings up the potential for conflict of interest. We all know there are conflicts of interest within the financial services industry, and if they're properly managed, that's fine. But within research, there is a significant conflict. And there's considerable effort to try to correct that conflict, or at least rule out that conflict. But it is very difficult. There are a whole range of different ways of analysing a fund from a qualitative basis, and the manager from a qualitative basis. Obviously, you need to research the manager. As a researcher, you need to research the manager. You need to look at what makes the manager tick, what their processes are, how long they've been established, what backup support processes do they have, what procedures do they have, what third parties are they using to ensure that compliance is correct, and that irrespective of performance, the money that you assign or you allocate to that manager is being well looked after. At the end of the day, it probably comes down to experience. You can check all the boxes and tick all the boxes that you might want to, but the experience of being able to look a manager in the eye and understand what they're doing and understand the strategy and understand that irrespective of the market conditions, the strategy is going to be followed is really important. Once you're comfortable with the fact that the manager is going to follow the strategy and the strategy is replicable, then you need to obviously make sure that the strategy that the manager is following is suitable not only for the portfolio and the investor, but is suitable for the market conditions at the current time. Now, market conditions change, as we all know, over time. But you need to make sure that what you're investing in is what you see is what you get. What you see is what you get often comes down to judging the manager. At Fund Monitors, it often comes down to a judgment call of the research analyst. Is the manager there to look after the investor's money, and is he there for the best interests of the investor? Or is he there for the best interest of the manager? Now, there always has to be a compromise on that. There's no point the manager being there and only being interested in the investor. He also obviously has to make sure he's got a viable business. But at the end of the day, looking after the investor's best interests is the most important factor. Will the manager do that? And when you do that, you also need to look at the research house and the researcher. Do they really understand the manager? Are they there researching and rating a fund because they're paid to do it, or because they think it's the best fund for a particular requirement? That's the difficulty, and it's not an easy balance to achieve. So when analysing a fund and looking at a fund and using external research, you really need to make sure that you're comfortable with that research. There are myriads of stories where managed funds have had positive ratings and recommendations, but in fact have failed. So it's not enough to just look at the research and say, that's recommended, therefore I'll invest a client's money in it. We remember things like Basis Capital. Basis Capital had terrific performance over a long period of time, had all the recommendations and ratings you could possibly want. But come the GFC in 2007, 2008, investors' money disappeared. It didn't disappear because there was anything untoward about the manager. It was just that the researchers hadn't done the work on the background industry and what the manager was investing in. It's no good just to rely on past performance. Have to get to understand what the manager's doing, and good research will let you know what the manager's doing and how the manager invests you and your client's money. The reason it's important not to take research at face value, to just look at the recommendation or the star ratings or whatever it may be, is that you don't know how good the research is until the proverbial hits the fan. It's when the proverbial hits the fan and the fund doesn't perform the way the research has done that it causes the problem. And until it hits the fan, you won't know. And that's why you need to do your own research and make sure you understand what the manager is investing in. Don't just take a rating at face value. Ensure that you have researched the researcher. In summary, use the research to understand all about the manager. Use the research to understand the performance and the risk history of the fund. And use the research to get to understand the strategy and the personality behind the people. At the end of the day, it's the people in a managed fund that are important. Even if it's a quant fund where you've got computers doing a lot of the decision making, at the end of the day, it is still being governed by a person. You need to be comfortable with the person.